Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to our BCI podcast number 32, titled Covered Call Writing and Blackjack. A valid analogy? Throwing the odds in our favor with PayPal Holdings, Inc., which trades on the NASDAQ exchange under the ticker symbol PYPL. Well, how can I compare Blackjack with covered call writing? The idea hit me many years ago when I realized that as a covered call writer, we are taking in income as we start our positions. I kind of looked at it like we were the casino as opposed to the gamblers risking their money in the casino. So with that said, let's have a look at our strategy overviews. First with Blackjack. Now, in the long run, most Blackjack players lose money. Why is that? And simply stated, casinos exist to make money, not to lose money. So all the algorithms that they set up are based on returning only a percentage of the money that's risked. Covered call writing, on the other hand, makes money for most investors in the long run. The reason for that is twofold. Number one, when we sell an option, we are generating income into our brokerage accounts. We are lowering our cost basis, thereby creating opportunities for successful trades. In addition to that, historically, the stock market moves up in value, 8 to 10% a year historically. So we have those things going for us, an appreciating market most of the time, but not all of the time. Plus, we're lowering our cost basis as we sell our covered call options. Now, either strategy can be managed to throw the odds in our favor. And really, as a covered call writer or a blackjack player, it behooves us to do so. Let's first talk about throwing the odds in our favor with blackjack. Now, given our two cards and the deal is one up card, we're fortunate enough now to have computers that will tell us what the best play is at that point in time. So as an example, if we have a two-card total of 11 and the dealer is showing a 6, a poor card, we double our bet, we double down. So we are taking action, giving ourselves the opportunity to enhance our returns. Another example, if we're sitting with 2 8s, that's 16, that's an awful hand to have. But if we split those 8s, now we're putting ourselves in a possibility of 2 potential winning hands. Now, another example is if we hold a 16 against the dealer's ace, wow, life is not good at that point in time. It's awful. However, the computers say that if we take a card, we're enhancing our chances of a winning trade very slightly. So we're throwing the odds in our favor, even though the odds are not very good either way. So those are examples of managing our blackjack trades. Now let's talk about throwing the odds in our favor with covered call writing. And we're going to turn, as always, to our 3 required skills. First off, we're going to start with stock selections. What are the best performers at that point in time when we're entering our trades? And we look at this from 3 perspectives. Number one, fundamental analysis, sales and earnings growth. These are the elite performers that institutional traders just love. We also look at it from a technical perspective. We look at a price chart from the perspective of trend and momentum. And finally, we have a series of common sense parameters, including minimum trading volume, avoiding earnings reports, and several others. So that's the first of the 3 required skills, stock selection. The second is option selection. So we look at the moneyness of the strike. Out of the money if we're more bullish, in the money if we're more defensive. We look at the implied volatility of our option premiums. If they're too high, we may want to avoid the risk of very volatile underlying securities. And finally, we look at the expiration dates. For me, I like 1-month options, something in that vicinity. We're going to show you 6-week returns very shortly. But right now, I would say monthlies has worked best for me. A lot of our members like to use weeklies, nothing wrong with that. Longer term options I try to stay away from for various reasons, but that's something else we have to factor in with our option selection. And then once we've entered our covered call trade, we have our position management to deal with. And that starts with our 20%, 10% guidelines. So once we enter a covered call trade, buy a stock, sell the option, immediately, seconds later, we enter a buy to close limit order based on 20% of the premium sold. So if we sold the premium for $2, we would enter a buy to close limit order at 40 cents or lower in the first half of the contract, and we would say change it to 10% or 20 cents in the second half of the contract. And in my books and DVDs, I explain why and give details, examples of each. But that's all part of the position management skill set that we must have to enhance our returns to the highest possible levels. Let's look at a real-life example now with PayPal, which at the time that I'm discussing this trade was trading at 88.77. We're going to look at 4 strikes. Once again, these are 6-week returns, 85, 87.50, 90, and 92.50. So the 85 strike had a bid of 5.55. That's in the money. The 87.50, also in the money, had a bid price of 3.85. The 90 out of the money strike had a bid price of 2.53. And the 92.50 out of the money strike had a bid price of 1.55. You'll notice that the in the money strikes have greater premiums because they all contain an intrinsic value component, which out of the money strikes do not have. So that goes to strike selection, the second of the 3 required skills. It depends on if we're defensive or bullish in our positions. Now, if we feed this information into the multiple tab of the Elman calculator, we're going to first have a look at the defensive positions of the in the money strikes. So the 85 in the money strike shows a return on our option, time value only, of 2.1% for a 6-week return. So to annualize that out, we multiply it by about 8.5, so it's about 20% annualized. Now, of course, there's no upside potential when we sell an in the money strike, but we do have downside protection of that time value profit of 4.2%. So that means that PayPal can decrease in value by 4.2%, and we still will have achieved our 6-week return of 2.1%. Now, looking at the other in the money strike, the 87.50, the calculator shows that we have a time value initial return of 2.9% and a downside protection of 1.4%. So if we're looking for the greatest protection and our goal is to get at least a 2% return, we might favor that 85 strike that gave us a 2-1 with downside protection of 4.2. Now let's look at the 2 out of the money strikes. The $90 out of the money strike generated an initial time value return of 2.9%. You'll notice that the out of the money strikes are all time value. There's no intrinsic value component, and therefore there's no downside protection of that time value profit. There's always a break even. So we can get a 2.9% 6-week return on the 90 strike with the possibility of an additional 1.4 if PayPal moves up to the 90 strike. So we have a 4.3% possible 6-week return. Now looking at the deeper out of the money 92.50 strike, that shows us a 1.7% 6-week return with the possibility of an additional 4.2% if PayPal moves up to the 92.50 strike by expiration. So there we have a 5.9% possible 6-week return. So if we're going to be more aggressive and more bullish, that 92.50 strike looks pretty appealing, really, as does the 90 strike. Either one will do to take a bullish stance with our covered call trade. So let's take an overview now of covered call writing. We select the best stocks. That we're throwing the odds in our favor every step of the way. We select the best options, and once we enter our trade, we are ready to become into position management mode, which starts by entering our 20% guideline buy to close limit orders. That may never happen. We may never have to do any exit strategies, but if that threshold is met and we buy back the option, now we're in a position to take the next step, which might be to wait to hit a double, to roll down, to sell the stock, depending on various parameters, all detailed again in my books and DVDs. with specific examples, charts, and graphs. So let's summarize now. Throwing the odds in our favor and taking advantage of exit strategy opportunities are factors that distinguish blue-collar investors from all other option sellers. That's so important to be able to manage our positions after the trades are entered. Sometimes we're going to have a losing trade. Let's face it. Not all trades are going to be winning trades, and there may not be a great play at all, but there's always a best play, and it's our obligation as blue-collar investors to find that best play and to take advantage of it. So improving our opportunities for successful outcomes can be applied to both option selling and blackjack. Difference is, with option selling, in the long run, we're going to make money, whereas with blackjack, in the long run, most will lose money. That's just the way the system is set up. Now, for more detailed information on option selling, not blackjack, go to the bluecollarinvestor.com store, and we have a series of videos, ebooks, soft and hardcover books, calculators, and much more to help enhance your knowledge level as it relates to covered call writing and selling cash secured puts. So that ends our BCI podcast number 32. I want to thank everybody for taking the time to listen and perhaps watch this podcast, Covered Call Writing and Blackjack, a valid analogy. I hope you find this information useful, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.